Okay, so a one measure of risk is beta, which is a very popular measure of risk, and it refers to the beta coefficient. And this is last time we talked about correlations, perfect positive correlation, the one, perfect negative, a negative one, and zero. Now, a beta coefficient is sort of an evolution of this idea of correlation, looking at the price of a stock in comparison to the price of the market. So the S&P 500 goes up 10%, your stock goes up 10%. That's a perfect correlation. S&P 500 goes down 15%, your stock goes down 15%, still perfect correlation. So the beta measures on both the positive and negative side of correlation how your stock reacts to the market. So for today, the market, say, is not doing well. If your stocks are positively correlated with the S&P 500, then your stocks are going negative today, going down. If they had a negative correlation, such as an ETF, exchange traded fund, that was short the market, or short S&P 500 exchange traded fund, then as the market went down today, your stock would go up. And I had an example of a stock that this stock here is sort of, actually this is a VIX indicator. This is a short-term future ETF based on the volatility index, not the S&P 500, but the more volatile the stock market gets, the more this goes up. So if there's volatility and risk in the stock market, prices go down. This is not based on the S&P 500, but it has a negative correlation with the S&P 500. So the S&P 500 goes down, the stock goes up. And just to be aware, I do own this stock. So whatever I say about it, take with a grain of salt. It's extremely risky, though. You can see how this is so highly leveraged as an ETF, as a exchange traded fund, that you got to be very careful. This is something I only have a small amount of shares in. I just play with it. It's very risky, but it's one of the things I bring it up today because it's one of the things I know is negatively correlated with the stock, with the S&P 500. So that helps to sort of hedge my portfolio. So I have a lot of long positions of great stocks, but sometimes when I feel there could be market uncertainty, I may hedge my portfolio with one of these risk indicators. So if I feel like there are risks ahead, and I outlined 4 of them before, then I may want to hedge. You could also hedge your portfolio by temporarily buying puts. So you can get put contracts. We're going to go over options in a later chapter, but options are just sort of like you have the option to buy or sell a stock short. So put contracts give you the right to sell stock short. So you can buy put options to also hedge your portfolio. And you can also sell stock short if you want to create a hedge. But if you create a perfect hedge, you buy the S&P 500 index and you sell short the S&P 500 index, the same amount of shares in, say, a mutual fund or an exchange traded fund, then your return is always zero because one goes up, the other one goes down equally. So you might as well just not have your money in stocks. So stocks can be generally beta. I've seen them as high as 3 and as low as -1 or -1.5. But they could certainly be 5 or -5. It's not like the correlation scale that goes from 1 to -1 and that's it. Beta can go from any range above or below 0. So stocks with beta greater than 1 are riskier than the overall stock market. So if you had a stock with a beta, say, of 2 today, and the stock market goes down 5%, your stock's going down 10% because it's twice as volatile. So a beta of 2 would say the correlation is, the market goes down, your stock goes down even more because it's positively correlated and it's has even more of an effect over it based on that correlation. So if it's less than 1, it's less risky. So if your beta was, say, 0.5 and the market went down 5%, your stock would only go down 2.5%. it's slower. It reacts less. If your beta was zero, which I've never seen a zero beta, but if your beta was zero, there's no correlation. There's no telling what your stock would do if the market goes up or down. The best situation you could be is I don't think they put a beta on. You could find a beta under key statistics, and this is an ETF, so it doesn't have key statistics. Let's look at S&P. Trying to find a stock with a. I know. Do you know? Ever hear of cigarettes or Philip Morris? They generally have a low. If I look at their key statistics, so any stock you have, you want to see the beta, you go to key statistics, and beta is right over here. So it has a beta of 0.36, which is, you can see it's only down 7 cents today, which is a very low percentage, 0.22%, very not even 1%, because the beta is 0.36. So Philip Morris has a very small correlation with the S&P 500. If we look at a stock, let's see, Facebook, everyone's favorite stock. We jump to their key statistics. Would you think that Facebook's a negative beta, positive beta, greater than 1, less than 1? Less than 1? I think it's more than 1. Let's see. Okay. Oops, sorry. Oh, there is no beta, because it's not, the stock isn't old enough. It has to be a usually I think Yahoo calculates it on 5 years. So Facebook's not quite 5 years old. Let's see. No, Tesla's not 5 years old either. I'm looking for a volatile stock that's like an internet stock. Oh, maybe Amazon. So Amazon.com, that's been around for over 10 years. Let's look at there. So they're definitely going to have a beta. And if I look at the key statistics. Oh, actually, the beta's on the first screen there. So I don't even need to go. You don't even need to go to key statistics. I'm sorry. It's right in the first screen. And actually, their beta is less. It's less, close to 1, but less than 1. How long has Yelp been public? No. Let's see. Oh, Google. Let's try Google. That's been around for a while. Okay, so Google is actually less than 1 too. So not as risky as we thought. All right. Okay. So this is an indicator of, so if you do see a stock with a beta greater than 1, it's a risky stock. 2, very risky. So this could be, before you buy a stock, you should be familiar with the beta on the stock to get an understanding of how risky it is or how volatile the stock is compared to the market. Generally, stocks that have a huge price movements on days that the S&P 500 moves up or down are going to have a higher beta. All right. So stocks with beta less than 1, like we saw, are Philip Morris, Google, and even what's the stock I looked at before Google? Amazon have a beta less than 1, so they would be considered a little less risky. So here, let's look at if we have a positive range of betas between 2, 1, and 0.5, we could see that 2 is twice the responsiveness of the market, so that's why it's more risky, especially in a day like where the market goes down 5%, your stock's going down 10%. 1 would be the same as the market, and 0.5 would be half the response. So it would be not as so like cigarette companies usually have a low beta, so they don't react as biomedical companies, biotech companies have a higher beta. Now it is possible to have a negative beta, which I showed. It didn't calculate a beta, but I showed you some. There are some stocks based on volatility that are short volatility. So volatility increases, the stock price it's based on will increase, or they could be ETFs based on shorting the market, and those will have negative betas. And that's why sometimes in certain times in your portfolio, see the reason to have a hedge in your portfolio is because say you had the S&P 500 mutual fund and you made 50,000 on it already, but if you sell it now because you're afraid of turbulence in the market, so you sell it or you're afraid there's going to be a bear market, you have to pay tax on the $50,000 profit, which is going to be more than whatever the market's going to go down. So you can't win by selling it. So that's why a lot of sophisticated investors will hedge. So that way, any money they lose will be made up with the hedge, and they'll still have their intact investment, and they wouldn't have to sell it. And plus, they'll own it in case it does go up, and they won't be as penalized. Okay. So again, pretty simple. The higher the stock's beta, the higher the returns due to greater risk. So stocks with high betas generally have higher returns because they have higher risk. If you feel that the stock in question is not going to produce a high return, then you should not buy it. So if it has high risk and you don't feel like it's going to have a high return, why would you invest in something with a high risk and a low return? Okay, and here's just a couple examples of, a beta of 1.5 is going to equal a return. If the market goes up 10%, you're going to get a return of 15%. If you have the market went down 8% and you have a beta of 0.5, then you have a return of 4%, statistically. Okay, and you could, if you like I showed you, go to yahoo.com. Actually, the beta is on the first screen. You don't have to hit key statistics, so you could check your stocks betas, the beta on your stocks. These are now you can see that Amazon, I had just checked that it was at 0.77, so it's actually gone up since this slide was created probably a year or so ago. So you can actually look at historic betas and see, has the stock been getting progressively riskier or less risky? So these are just sort of betas stuck in time. Now, Bank of America has a high beta because during the financial crisis, it had a lot of price movement, and the same thing with Ford. Ford went down to single digits and then back up, and so stocks that had over the last 5 years that may have had some, a good amount of volatility are going to have a higher beta than stocks like Intel that was pretty stable during this period are going to have a lower beta, and also Microsoft is very stable as well. Okay, so these are just some very popular stocks. IBM has a low beta, and I think the highest. I guess Bank of America is the highest beta on this page. I would say that Bank of America beta is probably lower now than what was stated here, because let's see. I don't know the stock symbol for Bank of America. Here we go. BAC. So let's see. And well, actually, it's higher. If you see down here, 1.97. So still a lot of volatility. And remember, this is over 5 years generally for what Yahoo's displaying. So that has still the remnants of their turbulence in the Great Recession. Okay. So capitalized asset pricing model is another model that we could look at mathematically to calculate risk. And this model incorporates beta as its engine of risk. So this model will link risk and return together and give you an output of what your return needs to be in order to invest in the stock. So it helps you, this formula will help you figure out what's the required rate of return for an investment. And if beta increases, since beta is a component of this formula, your return needs to increase as well. Here is the basic formula. So the required rate of return means that for you to invest in the stock, this is what you need to have your return needs to be. So if you take we take the risk-free rate, and we're going to add that to, we're going to add that to this risk engine here, which we take the expected return of the market. So say the market's going to return 10%. And we want to subtract out the risk-free rate. We don't want to magnify the risk-free rate. So we take the market return less the risk-free rate, and we multiply it by beta. And then we add the risk-free rate back, since we took it out here, because we didn't want to magnify it against beta, but we still wanted it in there as part of our component of return. We add it back, and then that will give us the required rate of return on an investment. So the key thing here is beta. The larger the beta, the higher the required rate of return, because of the risks involved. So that's why the capital asset pricing model measures risk, and it uses that beta coefficient as its engine for calculating the return you would need to invest in any particular investment. The capital asset pricing model can also be displayed as a graph, and when it's displayed as a graph, we call it the securities market line, and that gives a picture of the capital asset pricing model. And to calculate this SML, you need the beta, you need the return, and then you just kind of basically plot them on a graph, and I'll show you an example of that. So you can see here that, okay, so here's the risk-free rate, and that remains constant. As the risk premium increases, the security line increases as well. So beta, you can see beta moving from 1 to 1.5 to 1.25 to 1.5 to 2. So as beta moves up, the required return, which is noted by this security market line, is also going to increase. So the greater the risk premium, of course, the higher the required rate of return. So if we were to map, we can actually map the capital. These are basically the results of the capital asset pricing model put on a line. And since the risk-free rate is consistent, the only thing that really changes in this formula is going to be the beta. So as the beta increases, return is going to have to also increase. So it's just a graphical representation of the effect of beta on the capital asset pricing model formula. Okay, so we're going to talk about traditional versus a modern portfolio theory. So let's look at the traditional approach. So traditionally, your portfolio construction was going to be a wide variety of stocks and bonds. So we have corporate bonds, treasury bonds, municipal bonds. We have large stocks, medium-sized stocks, small stocks, international stocks. So we build this basket of a portfolio that's going to be very well diversified. And we want to be within just about every industry. And the portfolio is represented sort of like an S&P 500 level of diversification, and focus more on well-known, less riskier companies, stocks that trade frequently and have a lot of liquidity. So as investors, you can feel comfortable. Okay, I've had my fingers in all the big stocks of the world, and I have a good complement of bonds and treasury bonds. And by the way, when there's unrest in the world, the U.S. dollar generally strengthens as people are afraid of currencies in other markets. They take their money out of those markets and try to put them into U.S. treasuries, because that's the most safest risk-free investment you can have. So the greater the world risk of war, natural disasters, currency battles, the more people want to throw their money into the U.S. dollar, which pushes up the strength of the dollar and lowers the rates and increases the returns on bonds. So that's why if you have bonds in your portfolio and there's unrest or increased risk in the world, that's going to strengthen, generally flight to capital, to quality capital, will strengthen the dollar and increase the returns of bonds. So even as generally as your stocks are falling, your bonds are appreciating. So that's why there's always been a strong call for having a mix of bonds and stocks in your portfolio. Okay. Now, more of a modern approach would be using mathematics and statistical measures. That's why if you're interested in business and finance, an AMS minor or major is a great complement to the finance degree, because a lot of what's done in corporate companies and investment banks and banks, they utilize a lot of statistics in calculating measurements of risk, return, and especially insurance companies as well. So, because the modern theory is we're going to use statistics to focus more on expected returns, standard deviations, coefficients, correlations, betas, and things of that nature. I'll move these erasers because I keep bumping it. Okay. So we want to look at, one thing we want to do with statistics is kind of measure the correlations of the stocks and build a portfolio where we have a combination of correlations that give us a well-diversified. So we don't look at diversification between industries, between different stocks. We look at, how do these stocks, their correlation to the beta, and how can I build a portfolio that sort of combines these different stocks at different correlation levels to give me a more diversified portfolio. You're not even looking at who the companies are, what their names are, what business they're in. It's all a statistical approach, to try to balance out the risks in your portfolio. And one of the statistical tools we can use is called an efficient frontier. And this is where we're going to actually map return and risk on a scale and figure out what stocks are on the frontier, which means they're going to have the most return for the least amount of risk. So this is the basic chart here. It looks like, I always think of it as an umbrella sort of looking type of thing. But the leftmost boundary is going to be where the efficiency is. And that leftmost curve is the efficiency. And I'll point it out on the chart in a minute. And that's where we have the best risk-return trade-off. Anything that falls to the right, their risk-return trade-off isn't as desirable. Okay, so here is the scale. So down here is risk, and over here is return. So Y, for this amount of risk, this is the most return in the stock market you can get, would be measured. The most efficient stock for the return versus the risk would be stock Y. So stock F has a higher risk and a lower return, so it's not as efficient. So it's basically what the scale is mapping. So we could take a bunch of stocks and we could map them on this scale, and each of these letters represent a different stock. So inside the umbrella here is sort of the feasible or attainable set of stocks we could theoretically invest in. But we want stocks that are closer to this efficient frontier, this blue area at the cusp, where the greater the risk, you'll see C has a great risk here and the highest return, as opposed to D, which even has more risk but a lower return. So we want to invest in stock C, not D, because it's sort of on the behind the frontier. So again, it's just scaling stocks, putting stocks together on a chart or a graph, and locating them based on, you can use the actual return. And this can actually it can also not be individual stocks, but here, these could be total portfolios. So these could be these letter positions. They can also be portfolio positions. So if you had A through T, and these are the letters representing, say, the different portfolios you could put together, you would want to have, I guess, portfolio O would be the best portfolio to have, that grouping of stocks in your portfolio, because it has the biggest return for the least amount of risk. This is the portfolio O here. So again, it'd be taking the stocks in your portfolio, crunching the statistical numbers on them, and plotting them into an efficient frontier. And then you could plot, maybe you have 14 different possible portfolios you want to look at. You can plot them all on the scale here and see statistically which is going to give me the most return for the least amount of risk. Okay. Now, we were talking about beta before as an individual stock. Beta on an individual stock. We could also take beta and we could find the beta of a portfolio. And what we do here, the beta on the portfolio, is we're going to find a weighted average of the betas in the portfolio. So again, I'll show you the formula in a minute, but this will give us a better idea of how correlated the portfolio is to the market. Not because you could have a bunch of individual stocks, but you want to sort of weight their influences on their beta and get, again, weighted average beta, so we could really look at that, your portfolio put together in relationship to the market. And remember that the only risk we're really eliminating here is the non-diversifiable risk we talked about from Chapter 4. And these are the risks that are relevant in this case. Okay. So this is a neat scale. So on this scale, we could see that this red line measures total risk, while the blue lines break up total risk into its two components, undiversifiable and diversifiable. So undiversifiable risk won't change. We can own every stock in the world, and we won't get any real benefit from undiversifiable risk. So if the market goes down to the market's just in a downward day, pretty much all stocks are affected. So we can't diversify from that risk. But up here, the top end of the scale, will measure the diversifiable risk. So this is the risk that if you have one stock here, this notes number of securities or one security in your portfolio, you have the most amount of diversifiable risk. And as you put into about, say, 25 different securities in your portfolio, you can lower this diversifiable risk quite nicely. You can't eliminate it, but this is the one risk, and it's common sense. Put all your money in Google, or spread your money out in 30 different stocks. Which is going to have a lower risk? Obviously, having the money in 30 different stocks. All right, so in these two, say we look at these two portfolios, and we have 5 assets in each portfolio, and this proportion is just a percentage, and the percentage is 100%. So stock 1 is only 10%, stock 2 is 30%, and stock 3, 4, and 5 are 20, 20, 20, which makes up 100 percentile. So that's how the assets are broken up in portfolio V. Portfolio double, W, has one stock. Stock 5 represents 50% of the portfolio, and the other stocks are less. And then we have the betas alongside each of these different securities in these two portfolios. So we want to see what is the weighted beta in W and what's the weighted beta in V to figure out which portfolio is riskier. Okay. So does it actually... All right, so if we multiplied, this what we'd call a weight, 10%. If we multiply this by the beta and get a result, and you do that for each of the 5 stocks, and you add them up, that would be the weighted beta. So over here, this stock would have the most heaviest influence on this portfolio since it's 50%, and this stock, these 3 stocks would have the lightest influence. So multiplying the weight times the rate, in getting the sum of those 5 results will give us the weighted beta. And I'm sure that formula is coming up here. And we interpret the portfolio beta just the same as an individual stock beta. So the higher the portfolio beta, the more risk, but also the more return. So a beta, say a portfolio beta 1.25 will return 12.5% if the market increases at 10%. So same concept. So the lower your portfolio beta, the less risk it will have. So constructing a portfolio with a group of low-risk investments will produce, of course, a low beta portfolio. But that might be great because you might feel safe. However, it's going to have very low returns. So you could have a very low beta portfolio, such as having most of your money in a combination of bonds and safe stocks, and that could give you a low beta portfolio, but it's also going to give you a low return. And that's why it's important to know how much risk you can tolerate. And the key thing here is, if your stock positions are keeping you up at night, or you having trouble sleeping based over the stocks that you have, then you have too much risk. You know that you're comfortable. If you're comfortable enough with the risk you have in the stock market that you could sleep well at night, then you're probably okay with your risk position. It's when you start to over worry about it, or it's constantly thinking about it, and you're concerned about the risk of your portfolio or the positions in your stock portfolio, then you have too much risk. It's not, your tolerance isn't set for that. So you either have to come to terms with the risk you're willing to accept or adjust your portfolio. And again, this is just, we've gone over this a few times now. The change in return in relationship to the beta, higher the beta, if it's a positive stock market, the more return you'll get as opposed to a negative beta. So if you're trying to, so this is for more sophisticated traders, not just a lot of people who are individual traders. They may trade stocks, buy a few stocks, just sort of like you're doing in the virtual stock market, but you have no idea what your portfolio beta is or what your plan of your portfolio is. You're just trying to trade for money right now. But more sophisticated investors or portfolio managers are going to want to think through it a little bit more. And they're going to want to think, how much risk do I really want to take in my portfolio? If I have my life savings here, my retirement, do I want to risk it all on trading Tesla back and forth? You know, so if we look in the virtual stock market, you see some people are trading very aggressively, and that's how they're getting. That's how Albert got his $1.6 million account. Is Albert here today? Trading very aggressively, but at a very high risk. So it'll be interesting to see if that level of risk can pay off continuously. Usually it doesn't. So seeking diversification between different types of securities is going to help lower the risk in your beta of your portfolio. Stocks, bonds, real estate, commodities such as gold can all help to have a more balanced portfolio. So having this portfolio beta calculated consistently gives you an idea of how the risk of your portfolio is changing. So risk changes continuously in your portfolio, and beta is a very quick way of measuring that. So if you had, at one point, you had a very low risk portfolio and you were fine with that, you may find 6 months to a year to 2 years later, the risk of the portfolio have increased greatly. So that may be a signal to adjust the securities within the portfolio. All right. And again, this is just a, if we look here as a risk return trade-off, this is the risk-free rate. So we have the portfolio return and portfolio risk. So we wouldn't want this portfolio here as a high amount of risk and a low amount of return. So this would not be a good portfolio to have. We would probably want to have C, because this portfolio has a low amount of risk and a high amount of return. All right, so that finishes up Chapter 5. And just to kind of reiterate what we talked about here in Chapter 5, we looked at understanding portfolios as an objective for meeting our returns as an investor, and we looked at ways to calculate return in a portfolio and a standard deviation. Key concepts of diversification, correlation, and international diversification were talked about. I described and talked about measures of risk and beta related to risk in a portfolio. Described why we would calculate a capital asset pricing model, why we would utilize that, and how it could be graphed in a security line. Talked about the difference between traditional and modern portfolio. Traditional portfolios are less mathematical. They're more sort of going by common sense guidelines of creating a diversified portfolio with the stocks we know and love and some bonds, where a more modern approach is to use statistical mathematics to better judge and calculate the actual risks of your portfolio. And then a good way to monitor the risk return in your portfolio is to create a beta for your portfolio and to use that as a guide to see what level of risk is developed in the portfolio. Okay, so that's chapter 5.